Greetings and welcome to Principles of Accounting 2, Chapter 3. This is the last material for Test 1. Test 1 will cover chapters 1 through 3. And let's see, the final is cumulative, remember that, so you have to know chapters 1 through 11 for the final. This chapter is on something we call the break-even point. Now, break-even is an important part of a company, right? We know that if you're below break-even, you're losing money. If you're above break-even, you're making money. So the break-even point, you can describe it in several different ways. One is where your profit is zero. Another way is your revenue equals your costs. Third way is if your revenue, we know that costs in this class consist of fixed cost plus variable cost. So fixed cost plus variable cost equal revenue, you're at break even. And finally, sales minus expenses equals zero. Break even on a contribution margin income statement looks like this. It's very nice. What you have here is, and I think I just made these numbers up. You have $500 worth of sales, $200 worth of variable costs, gives you $300 of contribution margin. Sales minus variable costs. If you have $300 worth of fixed costs, look at that. Your net income is sitting at zero. That's great because we call that break even. And let's take an example here. Let's say the sales price is $10 a unit. And we're sitting here at 500 sales. Your variable costs are $4 a unit. How many units are sold? 50. You take the 10 divided by the 500, or you can take the 200 divided by the 4. Should give you the same number. And then you take a little eye here, and an eyebrow, and a nose, and you've drawn a happy face on the slide. Okay, let's get back to accounting. Let's see, I gotta click on that, I think, and go down one. So there's three methods for calculating break-even. Now, those of you with a math background are going to realize that all three of these are going to be the same exact method. But if you don't have a math background, we'll just present this as three separate things. We have the equation method, which is sales minus variable costs minus fixed costs equals zero. Very easy, intuitive way of calculating break-even. Great way to do that is on the contribution margin income statement. Now, a lot of you know that sales minus variable cost equals contribution margin, and that's fine. And you also remember from algebra, you can move fixed cost over here and then divide, and what you end up with is a complete mess that looks like this. And that's our second method of calculating break-even. We call it the contribution margin per unit method. You take the fixed costs and you divide it by the contribution margin per unit. Not the total contribution margin per unit. The third method is the contribution margin ratio method. This is the method that I use twice a year, once in the fall, once in the spring. Now you get that by taking your fixed costs and dividing it by something called the contribution margin ratio. What is that? We get to that in a few slides, so let's hold off on that for a minute. And let's go down a slide. Okay, so using the formula method, we have a scenario here where fixed costs are $500,000. Your variable cost per unit, so this is total fixed costs. This is variable cost per unit. And your sales price, which we know is per unit, is $1,000. So then how many units do you need to break even? Well, what you could do using the formula method is you take 300 times the number of units you need, and you take 1,000, and this is kind of fun, times the number of units you need, and you subtract them, and then you subtract 50,000. Essentially, you're solving for you now, right? and that's all going to equal 0. I think that's the most backwards I can possibly do that formula. Okay, so solving for you, solving for me, you end up with 700 u equals 50,000. And u, which is units, equals 72, I hope. I cheated, I looked right here. Now that is in units, that is not in dollars. So we know that if we sell 72 units of something, we will break even. That's great, but as we know, financials are always in dollars, not in units. So if you take the 72 units, of which is how many of something we sold, times the sales price of 1,000, this is actually a lot more fun. I hope you're having as much fun as I am, because this is a blast to do. I'm probably going to fall out of my chair in a second. 72, wow, this is cool. $1,000, that's a dollar sign, by the way. And to be honest, if I was writing this on a chalkboard with my hand, it would probably look worse. $72,000 is the amount of sales you would need to break even using this scenario here. As you can see, it's all laid out in nice type right there. In general, this statement's very important. Unless they state otherwise, you always want to give break even in both units and sales dollars. It's just a good rule of thumb. Okay. Now we have this concept called contribution margin per unit. Easy concept. You take sales per unit minus variable cost per unit. Okay, so that would be, if sales per unit are $50, variable cost per unit are $25, your contribution margin per unit would be $25. So far, so good. Another mathematical way of doing it is like this. So if you're using Excel, that'll work. Or if you just, like the distributed property, that works. Is that the distributed? I don't remember. Yeah, it's been a long time. Okay, so if your sales price is $50, your variable cost per unit is $15, you just subtract these two numbers and you should get $35, which is your contribution margin per unit. Well, Joe, why is that important? Because you can figure out break even using contribution margin per unit. This is the easiest method of the three. You can almost do it in your head half the time. When you're doing it in Excel, even if you try to do the formula method, you're going to end up doing the contribution margin per unit method. Okay, so what you do is you take your total fixed costs, you shake them up. No, you take your total fixed costs, divide it by your contribution margin per unit. So down here we have $300,000 fixed costs, goes right into the numerator. Okay, now here you got your variable cost per unit, your sales price of 85 or 105. The difference is 20. Boom, those go in there. You divide those two, hopefully. I was running out of fingers yesterday when I did these slides. I got 150,000 units, and when you take the 150,000 units back to the sales price, a little over $1.5 million. Sweet. Okay, so far so good. Got that formula down. Now let's go to the contribution margin ratio. This is the weird one. Okay, so contribution margin ratio. You take contribution margin and you divide it by sales. That gives you the contribution margin ratio. That formula should look slightly familiar for when you did operating leverage, except in operating leverage, this was net income. Also, operating leverage usually gave you a pretty big number, like 1, 2, 3, 5. Contribution margin ratio is going to give you a very small number, meaning less than 1. So here, if you got sales of 10,000, variable cost of 8,000, your contribution margin we know is 2,000 because we subtract these two. That goes in your numerator. The 10,000, which is the sales, go back there, and boom. 0.2 is your CMR, which we will call contribution margin ratio. Let's see, let's go to the next one. Okay, so how do you find out break even using the contribution margin ratio? Looks exactly like the last formula, but we're only changing one letter. So if you remember the contribution margin per unit, to find out break even, you took fixed over CMU. For contribution margin ratio, we're taking fixed over CMR. If sales price is, whatever this number is, $800, variable cost per unit $640, fixed costs are $100,000, we can calculate the CMR to be 0.2. Right? You got 160, which is your contribution margin unit, divided by the 800, which is your sales price. And your break even, you take this over that. Now, this is different than the other two formulas. Contribution margin ratio, very important, gives it to you in dollars. The other two give it to you in units and you have to convert to dollars. CMR gives it to you in dollars and you have to convert to units. How do you do that? You take the 500 grand, divide it by the $800 sales price. No worries. Like I said, I use this about twice a semester, or twice a year, once each semester. All right, desired profit. Let's see, firm wants to make $1,000 profit. You're going to see problems set up like that, or they want to make $1,000 profit, or they hope to make $1,000 profit. Those are called desired profit. It's how much profit you want at the end of the day. Very similar formula to break even. Some would even say it's the same formula. And you can do it by using either of the three methods. So here is our break even formula for using the equation method. Normally this would equal 0. And instead of 0, we just make it equal to 1,000, the desired profit of the $1,000. Okay, down here, the contribution margin per unit method. Remember we had fixed cost over CMU is to break even. Actually, let's go down to the ratio. Fixed cost plus over CMU or CMR. All you do is you add desired profit to the numerator. So these problems are extremely easy, fast, dirty to do. And so here's an example. You have a sales price of $250, variable cost of $130, fixed cost of $90,000. Firm wants to earn $800,000. So what you do is you take your $800,000, you add the 90. That should get you $890. You divide it by the contribution margin per unit, which to me is the easiest one to do. 250 minus 130. Yesterday that was 120. Hopefully it still is. Gets you 7417 units. Multiply that by your sales price. Will get you 18 blah 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 sales. Basically that means the firm has to sell 7,417 units to make an $800,000 profit. That's doable. No problem. Depends on what the firm is. Okay, so here's your cost volume graph. You'll probably have to label this at some point. What you have a line here called sales, right? So here, dollars, units, you make no money at 0 sales. And then sales kind of happily go up, la 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 la. As we learned last chapter, we have fixed costs that are just sitting right here. And you have, this is called total cost. That's actually a mixed cost line. Remember, if it was variable, it would be down here. The slope's going to be your variable cost. Now, when sales equal cost, which is this little point right there, draw a little arrow or something, that's called your break-even point. Oh, that's what that looks like. Anything where you're below, well, here's where your sales are, below the break-even, this is your area of loss. I think I labeled it right here. And that's really going to be your sales minus your cost. This here is going to be profit, wherever sales exceed costs. Can't make more money than you sell, that's called fraud. So I put sea monsters up there to say nothing really gets labeled up here. Or sea monsters. Anything else in this chapter? Oh, there's more. There's the margin of safety, 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 safety. No big deal here. All the margin of safety is asking you is how much you can mess up your sales. Sales are estimates. What do we know about estimates? We just make them up. how do we make up a budget? We say, well, what did we spend last year? And we just plug that in and hope for the best. So they're never right. So with a margin of safety, if you have a big margin of safety, you can mess up your sales by a whole lot and still not go out of business, which is what you're hoping for. Well, no, you're not hoping to go out of business unless it's the producer's movie. But no, you want to, you always want to make money. So what you do is you take your budgeted sales minus your break-even sales over your budgeted. The book won't tell you this, but I'll tell you this. You should get the same number or close enough for government work if you use sales units or sales dollars. So here your budgeted sales are 6 million, your break-even sales are 4 million. The difference is 2 million. The difference would be this right here. So you take the 2 million over the original 6 million, 33%. That tells you your sales forecast can be off by 33% and nothing to worry about. You're still making some money. Good place to be. If it was 3%, you'd worry about it. Weighted average contribution margin, the whack-em. This is the hardest concept in the book, I think, although a lot of people argue with me that everything's hard. And there are some harder concepts as well, but this one's a little weird. Almost nothing on the test ever on weighted average contribution margin. However, there is a homework problem or two, and you'll use this in finance, portfolio management, stuff like that. You have a company with multiple products. This one has 4 products. Each product sells different amounts, right? This one's selling 800 units, this one's selling 900 units. And so they have what we call a sales mix, or as I put on this slide, a weighted average. Remember, sales for a company are aggregated at the company level. So $100 in company sales means that you're probably getting 28 bucks from product A, 21 bucks from B, 17 bucks from C. All you do is you take the 800 or whatever was sold by A, 600 by B, and you divide it by the total amount of units sold. Gets you a sales mix. Piece of cake. Now your CMU, remember each company is going to have their own contribution margin per unit. They've gotten that, or each product at least, by taking their sales price minus their variable cost per unit. If you take the contribution margin per unit and multiply it by the weighted average of their sales mix, you're going to end up with a weighted average contribution margin. This is telling you for that $100 in sales or $1,000 in sales or whatever it is. I guess it'd be for each unit sold, now that I'm thinking about it. Each unit sold, product A would be $142 of contribution margin. $192 would come from product B, $53 would come from product C, and $80 would come from product D for every single product you're selling. That's the weighted average contribution margin. It's a little scary. Feel free to look it up. All right. So here's what a weighted average contribution margin looks like, just using a slightly different format. Here I got 2 products. The nice thing about 2 products is they're much easier to pay attention to than 4 products. 25 units for product A, 75 for product B, which means, hey, nice round number, right? 100 products are sold. Gave you the contribution margin here, which means for each unit sold, you take the 25 times the 65. A contributes 50 grand of contribution. Oh wait, that's fixed cost. Oh, I should probably pay attention to what I'm doing. Okay, those are your fixed costs. Let's go on down here. Okay. We know our units sold, 25, 75. I just pulled that directly from that column. I know the weighted average. I took 25 divided by 100 is 25%. Those dollar signs shouldn't exist. 75 over 100, that's 75%. So for each unit sold, if I sell 10 units, let's say a quarter of them will be from A, 3/4 of them will be from B. Contribution margin, again, I just dragged that down. Now I'm going to do what I thought I was doing in the last table. You multiply these two and you get these numbers here. So you sell 1 unit, 156 bucks comes from product A, 1406 comes from product B, and your total contribution margin to the company is going to be 1526. 1526 is the company-wide weighted, I guess that's 1562, company-wide weighted average contribution margin, which is nice, but so what? Well, so what is you can figure out your break-even point using basically your contribution margin per unit method. You take your fixed cost over your weighted average contribution margin, and it will tell you how many units you need to sell. Easy, very nice. Is there anything else on this? I'm feeling there's one more slide. Oh, problems. I have separate screencasts for all of these problems except for this one. This one, the answer is actually in the textbook right next to the problem. So you should definitely work through those on the separate webcast. That's chapter 3. Good luck on chapter 1. Bye.